What's going on, Clarence?
Cornmeal.
Let's do it. Demon right. Whoa. Demon right. Spicy mafia. Spicy mafia. You gotta keep it spicy. If you see a queen, you better wife it. While we litter than a lighter, it makes things much brighter. So you gotta keep it spicy.
All right, so we are very lucky to have on the CoinSpice podcast this episode Eli Dourado. He is a kind of a big thinker, a thinky thoughter. He blogs. He does it really all. But recently I came across his 2020 could be the year Bitcoin's fee market is put to the test. And we're going to get metric, we're going to get numerological, we're going to get trilemma on you guys. But he is very much worth grappling with, considering. And before I get into the meat of the episode here, Eli, thanks so much for coming on, man.
Yeah, great to be here. Happy to talk.
Very cool. So before we get into the fee markets of BTC, which we'll colloquially just call Bitcoin, a little bit about your background. You're an economist, right?
Yeah, that's right. I'm a trained economist. I decided to leave academia or to not go down that path. But yeah, I have a PhD in economics and been following cryptocurrency, for 8.5 years or so, since early 2011, while I was getting my PhD. So I think I was actually, probably one of the first trained economists to really sort of start paying attention to blockchains and cryptocurrencies. And I think it's great technology, and I'm super supportive.
Very cool. And for our listeners, especially those on the tribal side, because we're going to get into some fairly controversial arguments here, how would you describe your leanings in the crypto world? Like, is there a project you're a little bit more sympathetic to or less? Or?
Yeah, so I'm relatively well known as having written a piece on Ethereum maximalism, which I don't mean in sort of a tribal way, but I think right now Ethereum's like the most interesting project going on, and to my mind, like Ethereum's going to be sort of, I expect it at some point to be the dominant cryptocurrency unless something else better comes along. So I'm not saying it's going to be the top cryptocurrency forever or anything like that. It's not tribal, not ideological, but just right now I think it's better than a lot of other cryptocurrencies, especially ones that really all you can do is transact with. Because with Ethereum you can of course transact and then you can do more. So why would you ever, why would the market settle on a cryptocurrency that has a more limited scope, is no better than Ethereum in the one thing it does, but then is also clearly inferior in sort of other ways? So that was sort of the argument that I put out a couple of years ago, about a year and a half ago, for why I expect Ethereum to succeed in the long run.
Yeah, and there's a lot to say for Ethereum, whether it's Vitalik and his big braininess, but also just the level. You could say, I think it's fair to say that they probably spawned the initial coin offering revolution. Certainly made smart contracts a thing, whereas they were kind of kicked around for a while as theory. And I think the rest of the projects are trying to catch up. Is that fair?
Yeah, that's how I see it. I also see it, in the 2013, 2014 timeframe. A lot of people were really excited about what a capability of Bitcoins, which is colored coins, as it was called at the time.
Right.
And we know them now as tokens. So like the Bitcoin community was talking about it, and then the Ethereum community did it. So nobody's it's not, of the top 100 tokens, something like 90% of them are issued on the Ethereum blockchain. So I just see the Ethereum community is a lot more pragmatic and non-ideologically motivated and sort of technocratic, and let's figure out what works, and then they just do it and they press ahead.
Yeah, and I'll agree with you there as well, because they've at least in my sort of outsider cursory look at them, they've always been willing to kind of reach across and look into other projects and dabble with other devs. So it seems to be a very healthy project as of now. I know there's a lot of criticism in other areas, but that's really not our subject here. But I think it's nice to kind of round you out a bit so that listeners know where you're coming from, because you're taking on basically a different idea here, and that is the proof of work coin par excellence, of course, which would be BTC, Bitcoin, and specifically its fee market. Now, in late 2017, I tried to give some Bitcoin, some BTC, to a longtime friend who was kind of wondering about my cryptocurrency obsession, and she was like, well, send me a little bit. And so we set up a wallet, we did the whole thing, and I think I gave her, I don't know, maybe $100. I don't really trust my memory right now, but I know the following did happen. So when I gave her about $100 worth of filthy fiat conversion here versus BTC, she then wanted to buy a gift card for Christmas, as I recall, and then got whacked with a $25, maybe even $30 transaction fee. I don't believe that's your point here, but ultimately, are you foreseeing that something like it becoming the norm on BTC if certain things don't change?
Well, I think that so Bitcoin and other coins like it have a very serious problem that I don't think people have really started to confront yet, which is that at some point, sort of issuance dramatically slows down and eventually stops. Right? It's a fixed supply coin, and that means that for security, it's going to have to rely entirely on transaction fees. So that means that that the transaction fees that happen are what is securing the blockchain. And it may be, one possibility is that the fees go up, and then what you end up with is, sort of everybody has to pay that much to do their transactions. And then, blockchain security is fine. Or the other possibility is that the fees don't go up and everybody, still transacting for a relatively low amount, and then the blockchain is insecure. So the question is, like, which of those futures do we get? And by the way, there's nothing in the fee market, in the way that transactors and miners interact with each other, that guarantees that an adequate amount of security is provided. So it's a very interesting thing to think about. Is what is that going to look like? Sort of as the miner rewards fade away. What is the equilibrium fee, and then what is the equilibrium level of security, and does the amount of security produced result in transactors that are willing to pay the fees that it costs?
And you're not talking about in the far distant future. You're saying that come May of 2020, these problems may start rearing their head based on what you calculate as, and you say there's a bunch of assumptions here, and you take averages that are empirically available to anybody who wants to look. But you're saying that this is something that's going to happen in real time, as if not a first, among the first types of experiments of its kind economically, with a multi-billion-dollar, I'm not sure what to call Bitcoin. It's not a company or conglomeration, but institution, maybe, right?
Yeah.
And,
it's a
so first, what is a block?
$100 billion.
Go ahead.
It's a $100 billion institution. We're gonna figure this out in real time. So yeah, it's basically, the block reward on Bitcoin, started out at 50 Bitcoins per block, and then it halved once, the first halvening, and then to 25, and then it halved again to 12.5. And it's scheduled to have again in 2020, in sort of May 2020 timeframe. And at that time, it's going to go down to 6.25 Bitcoins per block. So that means that the miner rewards that come from issuance are all going to be cut in half. And the question is, for the last several years, Bitcoin has maintained, a security level. Now, I'm not sure this is the best way to think about security even, but one way to think about security is what of the percent of daily value of the amount of total volume that is transacted on a given blockchain in a day, what percent of that count becomes miner revenue. Because when the revenue is high, the miners have a strong incentive to expend hash power to secure the network. And when miner revenue is low relative to total value transacted, that means that the value on chain is like a sitting duck for some sort of reorganization attack. And so the question is, what is the safe level? For the last year or a couple years or few years, Bitcoin has hovered around sort of like a 1 to 1.5% sort of miner revenue to daily transacted value ratio, and even with the last halvening, that the price was still going way up, and usage changed in such a way that it maintains sort of that level of security.
Kind of provided cover, right?
Yeah, but we're less than a year away now. It's possible that sort of like transacting behavior will change in the next year, but sort of just extrapolating forward, if nothing really changes, you're going to see that security metric that we were talking about earlier. It's going to go below 1%, and sort of well below 1%. And that's the level that some people in the community are arguing is the secure level. Now, there may be reason to doubt that as well, but we're still talking about new territory for BTC at least.
Yeah, it's super interesting, and I have a bunch of questions here, probably too many to be honest. But going back for a second, because you and I both understand a lot of the terms that you're flinging out there, just for those who may be stumbling into the podcast episode here and kind of wondering what the big deal is. The halvening part is built in. It's baked into the cake. Part of the white paper. It's supposed to do that. In your estimation, Steel manning that argument, I guess. Why would Satoshi or the group or whomever it is decide that was important? An important part of the construct.
Yeah, so the halvening of the rate of issuance is in place to limit the total supply of the currency, right? If you didn't reduce the currency issuance over time, the currency would be issued just indefinitely over time, and that would result in a sort of non-finite money supply, which is something that Satoshi seems to have thought would be important in a cryptocurrency. So the idea of having a fixed supply, any currency with a fixed supply has to bring issuance down over time, and they have to eventually get it down to zero, or else it doesn't have a fixed supply.
Right. And that's to, I guess, mimic as best as we can through emails and message boards and so on, kind of divine his or their intention was to sort of mimic gold, which in and of itself isn't necessarily a finite resource, but as close as we can get to commodity money. Am I stating that correctly?
Yeah, I think that's right. I mean, interestingly, gold is pro-cyclical in terms of mining. So when you have a business cycle, we do actually see in the real world gold mining increases when there's a boom in the overall economy.
That's right.
Gold mining increases, but yeah, that was basically the idea is to sort of protect people from sort of, expropriation of wealth through inflation. The idea was we're going to have a fixed money supply in Bitcoin.
And this is so tightly mathematical that it's extremely unforgiving. So like in the gold scenario that you just whipped out here, it's basically, not going to allow for supply to meet demand in kind of the traditional ways that we've understood those two concepts, and it's going to go to zero essentially if nothing changes. And that again is kind of another first if we're thinking of Bitcoin as money, or am I right about that?
In terms of it's a first in terms of like the world's first currency where they've been able to guarantee
boom, this is it.
Yeah, where they've been able
mm-hmm.
to guarantee a completely finite supply of money forever. Yeah, I mean certainly you have to go back maybe a long way in history to get to another currency where we knew that there was a finite amount. So yeah, that is very novel.
Mm-hmm. And some people argue that it's really not, that's even the Bitcoin, BTC, or whatever we're calling it now, is actually not finite because of the by definition it's open source, it can be forked, and so now we have a trillion different variations on that theme. Does that factor in at all? Because I don't remember seeing it in your paper, but in your blog post. But does that have anything relevant to do with what we're speaking about?
Well, I think it does, right? And the issue is that think about it in terms of the sort of demand for transactions, right? If there's only Bitcoin, and Bitcoin is the only cryptocurrency, and there's no other chain that has forked it or that has copied its source code or so on, then you could imagine that the demand for transactions could plausibly be so high as to pay high fees that then secure the network. But in a world where it's like, okay, I'm faced with this like $40 transaction fee, I can just go over to a different blockchain and pay 20 cents or something like that.
Mm-hmm.
Then that puts the Bitcoin's fee market in competition with other blockchains' fee market, and that could potentially further reduce demand for Bitcoin transactions.
And that's essentially, and they don't have representation between the two of us. That's essentially what drives Bitcoin maximalists just up a wall, right?
Yeah, I think that's right. Is that they I think in some ways the Bitcoin maximalists are right. The on one hand, they support. I think they're probably very concerned about this problem that I'm raising, right? And they're concerned that there will be competition from other coins, which reduces transaction demand, and they are also very opposed to large blocks, which lowers the equilibrium price in the fee market, right?
Mm-hmm.
So because I think it's because of a commitment to a fixed money supply, and because of a commitment to proof of work, we can derive perhaps some of their behavior towards other projects and towards large blocks.
And this is probably why, and I don't want to get too far off into BTC maxis, but this is probably why they're working so diligently, or at least in terms of the narrative, of putting out things like second layer solutions like Lightning Network and so on.
Maybe, but then even the Lightning Network would be could potentially be a substitute for on-chain transactions, right? So if their scaling solutions for transactions work too well,
I see. Yeah.
then that further reduces demand for on-chain transactions. So I think that doesn't actually wouldn't actually solve the problem here.
That's a good point. Yeah, this sort of just moving the problem over.
Yeah.
Okay, so let me quote you here, because you've chipped around at it, and I just keep moving you off the subject because I cannot focus. But you talk here about notional security deficit, and I'm going to quote you: to make up that deficit in transaction fees, average fees need to rise to around $20 per transaction. I'm kind of taking you out of context here. So as of May 2020, to maintain one idea of what is considered adequate blockchain security, transaction fees need to rise at least 16-fold while maintaining full blocks. Now, Professor Dourado, can you justify that claim?
Sure. Yeah. So the simple way of looking at it, right, is Bitcoin today has about $1.4 billion worth of transactions that it supports a day. And sort of the argument is that if you want to maintain this 1% security level, you need to produce the system needs to produce $14 million in mining revenue. And so the idea is once the halvening happens in 2020, Bitcoin miner revenue will fall, according to today's prices, to about $7.4 million. So you still need to make up $6.6 million in miner revenue. And so the system supports around 320,000 transactions per day. And so that means that you need to raise $6.6 million over around 320,000 layer one transactions per day. And so that means that's pretty expensive. So you're talking of something around so $16 to $20 a transaction.
And in your summation, I could see the BTCers, notoriously they've made comments when during my late 2017 anecdote here, they were saying things. These are developers, of course. Saying things like, well, I'm popping the champagne. This is, glorious. I'm so glad the fees are going up. So maybe in a weird way, they're sort of keeping, because you've pointed to, and we'll get into the trilemma in just a second, but you've kind of pointed to like sort of the looming question throughout your blog post is why? Like why would a $20 transaction, obviously if you're sending $6 billion, is great, but if for most of us $20 is just completely out of the question. So why do you think they would support that, or just kind of keep it that way, or just ignore the problem altogether?
Yeah, I think that they see Bitcoin as a sort of base settlement layer for a bunch of layer 2 activity. And so they think, you'll make your purchases and so on layer 2, and then they sort of the layer 2 nodes will use layer 1, the blockchain, to do the settlement. The challenge with that is, is it really the case that you're going to have, if that vision plays out to the extreme, are you really going to have 320,000 transactions per day worth of demand? At that high fee level, if there's less than 320,000 transactions demanded per day, then there's nothing stopping the transactors from spending less money, right? On the transaction fees. Mm-hmm. There's nothing about the fee market that keeps it so high. So I think it's even if they see sort of the ordinary transactions happening on layer 2, I think you still have this inescapable logic of you need to have a lot of miner revenue, and I don't if everything moves over to layer 2, I don't see that happening.
Yeah, I'm starting to believe, as I think I did even going into this, and you're sort of confirming it for me now in a roundabout way, that this is really a philosophical debate. Besides the empirical questions that you're raising, right, about sort of the function of what it is that this thing is, right?
It's a little bit philosophical, but I also think it's extremely empirical. Because if you look at, I follow, of all these projects, I probably follow Ethereum the most closely. And I'm looking at, sort of the research that they've done over the last 2 to 3 years about, when we move over to proof of stake, we have to consider all these things, all these incentive structures, and think about what is a sort of incentive compatible way to make the system secure and work in perpetuity. With with sort of the proof of work blockchains, I see not a lot of research in sort of that incentive dimension. I see instead sort of a taking as given, sort of Satoshi's initial incentive mechanisms that came out when the Genesis block was released and the Bitcoin code was first released. So there isn't a lot of examination of how should incentives be better or different in order to make Bitcoin stable in the long run.
And that definitely goes across more than just BTC, which we will touch on shortly here, and it kind of gets into a project closer to my heart, maybe even quicker. But before that, what role do selfish miners play in all this? You write blocks cannot or can't accept 500,000 transactions per day at current average sizes, so these will bid up until the quantity of transactions demanded equals block capacity. And so basically what you're saying here is you go a little further down, you say selfish miners interested to accept an additional transaction at a lower fee it seems to me to be kind of a key concept. Can you flesh it out a little bit?
Yeah, sure. So let's say that Bitcoin blocks are not filling up, right? Because initially, let's say the fees are too high, so the blocks are not filling up. What that means is that as an additional marginal transactor, I don't have to pay the high fee. I can pay a lower fee. I can offer a lower fee with my transaction. And the logic of selfish mining is that as a selfish miner, I will include that, even if it erodes sort of the market power of the miners in general, right? Even if it causes fees on average to fall, and I don't want fees on average to fall. As a miner, I want fees to be high, but I'm going to accept the lower fee if the block isn't full anyway. The only reason I would exclude it is if my block is already full with higher fee transactions. So we can expect, I think, this market, the fee market, to clear like any other like really competitive market, and that means that if the demand isn't there, fees are going to be low. This is a market with infinitely zero elasticity, right? So perfectly inelastic supply, and that means that price is extremely sensitive to demand.
And you basically call it a potentially unraveling market, and you use that as kind of a way to encapsulate the Satoshi quote that kind of looms over all of this, which is in 20 years, from a Satoshi quote from the white paper, in 20 years there will be either a very large transaction volume or no volume. And I think that not only goes to what you're talking about, but this spreads to other projects. And one of them, of course, is Bitcoin Cash, which is utterly perfect, without blemish, and we have nothing to worry about, right?
Well, so I wish the Bitcoin Cash community well, but they the problems that I'm outlining here for Bitcoin are potentially even worse for Bitcoin Cash. Bitcoin Cash is
okay. This is where we're gonna have to edit. We're gonna have to cut you off. Stop the recording. Yeah. I'm sorry. Go ahead.
Yeah, no worries. So Bitcoin Cash is, of course, based on the original, sort of Genesis block as well, and the rules of the Bitcoin network from the beginning, and it includes the halvenings. So it too is expected to have a halvening of block rewards in May 2020. And the challenge with Bitcoin Cash is that the ratio of transaction volume or of miner rewards to transaction volume is actually lower already than Bitcoin's. So we talk about Bitcoiners themselves feel that 1%, this 1% metric is sort of the right level of security that they need to maintain. Well, Bitcoin Cash is already at something like 0.1%. So it's significantly according to this metric, right, it's significantly less secure. And so the
How
question is,
dare you? Keep
it,
going.
the question is, if it when there's a halvening, and let's say Bitcoin Cash gets down to like 0.6% or 0.06% in terms of this security metric.
Mm-hmm.
Does that, I think you could actually see the problems there first, in the sense that people might start to see an opportunity to start attacking it and to reverse transactions and so on.
Yeah, that's going to be fascinating to watch unfold. And I say that as, of course, a partisan, with maybe some bags to protect. But it is a bit like BCH is, I guess, kind of the canary in the mine shaft, right? Do you think people like you and others who follow this so closely will be watching the likes of Bitcoin Cash to kind of see how that plays out?
Yeah, I think that it's a really good canary in the coal mine, in terms of I think reasonable people would look at it and say, okay, if it starts to experience these attacks, we at Bitcoin BTC should probably start paying attention and observe like sort of the level that we think is secure from BCH. Where did the attacks start to happen, and are they continuing? It's possible, of course, that they could completely ignore the lessons and say, see, we said BCH was going to die anyway, and they could not attribute it to this feature that sort of their project also has. So I see these as in the long run, the incentives of the two projects are the same. They both have they're both proof of work coins with fixed supplies, and so the incentives, it's not obvious to me why the incentives would ever be different.
Yeah, and it is going to be something to watch for sure. And I, of course, will blame you if it all falls apart. Let's see. So what we're really getting down to here, sort of the meat of everything, what it comes down to is the trilemma, which I think you put pithily and succinctly towards the end of your blog post, which again we will point to in the show notes, but it is called 2020 could be the year Bitcoin's fee market is put to the test, and it is well worth reading. So back to the question here. Towards the end, you talk about the trilemma. Can you get into what that is and really why it sort of drives the thesis?
Yeah. So the observation here is that really, in the long run, if you have fixed money supply, then it's the fee market that provides security in a proof of work currency, and it's really possible that the fee market revenue is not going to be enough to do that. So we may be in a situation where you have your choice is, you can have fixed money supply, you can have proof of work, and you can have adequate security, but you can only have at most two of those. So if you hold on to fixed money supply and proof of work, you might not have adequate security, right? And then another way out of that is you decide, well, okay, we're not going to have a fixed money supply. We're gonna keep miner rewards high, sort of indefinitely. Okay, that's another way out of it, is that you induce continual mining rewards, but then you don't have a fixed money supply. And then the alternative, which is still experimental, to my mind, is move from proof of work to proof of stake, and that's another way out, because you have other mechanisms like slashing and so on that affect the incentives in a way that proof of work doesn't. So those could be the choices that various cryptocurrency projects face, and it'll be interesting to see if that's the world we live in, where you can only have two of those.
It's very convincing to me, very, very, very convincing to me. And whenever I'm convinced, I tend to go get a glass of water and put a towel down on the floor and just kind of splash my face here, because I'm hoping, and this could just be the hopium part of me from the BCH community, that maybe there's a fourth way we're not considering, and in some way rather, devs or some smart gal or something could fight our way out of this. But you're saying absolutely not, that this is boxed in. You're going to have to do one of these three.
Well, I mean, so I don't know. I mean, it could be the case that, and this is where I think it would become highly, highly empirical, right? It could be the case that transaction demand is so high that the sort of the fees that people are willing to pay sort of cover the security that's required, right? So if you think about if the metric is that you've got to have 1%, which I think is probably empirically it's probably too high, because we see successful coins with less than that, but let's say it's 0.5%, right? If people are willing to pay 0.5%, sort of average fee forever, then it could work. The tricky thing is that the fees are not imposed by sort of the value of the transaction. They're imposed by sort of like the size of the transaction in bytes. So what that really favors is extremely large transactions on the blockchain that are paying less than 0.5% in fee, and then sort of the smaller transactions on the blockchain in terms of value are going to have to pay a higher percentage in terms of fees. And then the question is, does that work out in terms of providing an equilibrium? One way around this, of course, is decrease the block size, right? If you have a smaller block size, you could sort of drive demand way up.
And we've seen this actually with Luke Deshir talking about slamming it down to like 300 or something, just taking it even further down.
Right. So it's so I'm not saying there's absolutely no solution. I'm just saying this is really an empirical question, whether this market works out or not. The unraveling phenomenon is real. It doesn't hold in sort of all possible world states, but it's it's possible that it could happen.
Wow. I've kept you way over the half an hour that I said I would have you here. So just to abuse you a little bit more. So when you say empirical, you mean that we're just going to have to kind of watch what happens. So we have all this theory. We have a lot of hypotheticals, and we have sort of past experience, but nothing quite what we're facing. And even though the trilemma seems to be foreboding, and it seems to be these almost game theory like choices, it still comes down to, so I guess in the crypto world especially, there's kind of an ethos that runs through open source, kind of the old cypherpunk ethic of if they can, they will. So if you assume, like, it's sort of in the selfish miner scenario, someone's going to do it. So if security, that ratio you've spoken of so much here, if that drops, that someone could attack it. But empirically, it could just be that people's I don't feel like doing it, right?
Well, no, I don't think that's right. I think the empirical question really is, what is the demand for these layer one transactions, right? And like what is the elasticity of demand, and what is the total amount of demand for these transactions? And I think that is something we just don't know yet. We have to find out, is the demand going to be high enough to sustain full blocks with high fees? And if it's if it doesn't in the long run, if you don't have full blocks with high fees, I don't see how you have enough security to secure your proof of work blockchain.
Boom. Wow, what a fascinating discussion. I've learned a ton here. And I really urge everybody to get out to your blog. And speaking of which, how can people follow your work, and where can they find you?
Sure, yeah. So the easiest ways are on my blog and on Twitter. So I am Eli Dourado on Twitter, and I'm elidourado.com on the web.
get out to elidourado.com. That's ELIDOURADO.com. And the article or the blog post we've been discussing is 2020 could be the year Bitcoin's fee market is put to the test. Amazing conversation. I appreciate the generosity of your time and for educating us here. We super appreciate it. And thanks again for coming on, man.
My pleasure. Thanks for having me.